Welcome to the Turnaround Podcast with your host, Stephen Phillips. In each episode, Stephen speaks to experienced practitioners who discuss their careers, key moments, challenges, and lessons learned in financial turnarounds and business restructuring. Join us as we unravel the secrets to turning struggling businesses into success stories. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, frilibertas.com. Now, here's the host of the Turnaround Podcast, Stephen Phillips.
I'm thrilled to welcome an old client and esteemed industry expert, Clark Nicholls, to the show. Clark has recently launched Aucit Investment Management, a long-short fund specializing in high-yield bond investments. And I'm delighted to have him here to discuss his career journey and the exciting opportunities he is pursuing with his fund. Clark is a true veteran of the high-yield industry in the London market. He is the founding member and a board member of the European Leveraged Finance Association and has also served on the board of AFME High Yield Division at the Association for Financial Markets in Europe. I first met Clark during his time as a senior portfolio manager at AXA, and over the years he has held several key roles at leading financial institutions. Over the last 20 years, Clark has earned numerous first rankings in sell-side research, such as from Institutional Investor, and on the buy side, the team was recognized with the European High Yield Fund of the Year in 2022 by Financial News. Clark's expertise was built working with exceptional teams, and I hope to tease out his holistic approach to maximizing investment performance in the show. Clark Nicholls, welcome to the Turnaround Podcast.
Thank you, Stephen. It's my honor and pleasure. Look forward to talking.
Fantastic. Well, we did have a little chat beforehand about disclaimers, etc. So I think the main thing that we're going to say is that you're not giving investment advice on this show. It's really about you, your career, and everything that you've learned in that long career. And to sort of set the background, I'd love to hear a little bit more about your career to date. So maybe that we can kick off with that.
Certainly. Interestingly, I was listening to the previous podcast with David Buchler, and he mentioned a nice way to explain what he did was aligned with a company doctor analogy. I say it's interesting because my motivation for doing what I do now all started actually when I was about 7 years old, and I'd written down actually I wanted to be a company doctor. I understood what a family doctor did, and I just thought you could do that for companies too. But really what that led to was it inspired me to really understand, I would call it the economics, or what you do when you're looking at a company from a consultant perspective. And in that context, really understand the drivers of performance and sources of risk. And for the last 20 years, a little bit over 20 years, been doing that for European high yield. And obviously in the last 10, as you mentioned, with a large firm, AXA, in their European high yield team.
Yes. And I guess let's talk about high yield. I think as a lawyer, I would sort of define it in the European market as it has debt incurrence covenants rather than maintenance covenants. It tends to be high yielding, higher interest rates. It's usually New York law governed. Is there anything else that you would help, the audience with a definition of what you would invest in?
Certainly. I mean, there's broad characteristics and there's always exceptions. But just to start at that top line, I think for a high yield bond, it has typically about 150 pages of covenant details about each company. Just 1 second. You have to go. Sorry about this. You might have to cut that.
No, it's all part of the show.
Wonderful. Love that. All right, so it has the 150 pages worth of covenants, and then that really differentiates it from an equity investment. What I mean
Mhm.
by that is, if you didn't have those covenant protections, you would actually be effectively investing in equity. Where there are other differences in how it actually comes out is usually you'll have about half the volatility of equity and maybe half, two-thirds of that equity return. The coupon
Mhm.
and the repayment at par at maturity are factors that mean that the bond will mature, usually typically 3 years for a high yield bond, typically about 8 years for an investment grade bond. Those
Mm.
elements, again, give greater assurances that you get your returns as opposed to, let's say, in equities, where it's a bit more risky, but a bit more returns.
Got it. And I presume what we're not talking about are sort of investment grade bonds from BP or Shell or something like that. It has to have a characteristic of a kind of non-investment grade element. Is that right?
Yes, yes. For instance, what would I say? There is often a smaller size or less diversification or less competitive advantage. There's a very good
Mm.
set of checklists you can typically have, but ultimately there is a greater risk to your returns as a company for some aspects. And I'm not exactly sure why, because each one's different. But the typical one that a high yield investor does like is that which is, highly levered but a strong company, a company that has the
Yeah.
potential to produce good cash flows that will repay the debt. But also, if you look at the two alternatives, the highly levered strong company versus the lowly levered weak company, you can guess where both those companies will be 4 or 5 years' time. 9 times out of 10,
Yeah.
that highly levered strong company, through its free cash flow, will delever and improve in its credit profile.
And what about so-called fallen angel bonds, which are obviously high former investment grade bonds, but they've fallen in some kind of distress? Is that something that you would count as something you would look at investing in as well?
Yes, I mean, for my particular strategy is not set to be high yield, but that's where the
Mm,
greatest source of opportunities are. And
mm,
typically, you're investing where there's, let's say, some alpha opportunities, and often the
mm.
technicals related to an investment grade credit coming down into high yield and then potentially going back up mean that there's
Yeah.
quite good risk return opportunities. The typical and the obvious one is those investment grade funds that hold that particular bond when it becomes high yield are technically often forced to sell, and those forced sellers are often less price sensitive and so will give up some performance just to meet their mandate. Whereas if you're buying without that mandate, then you're opportunistically picking up extra yield with no risk, essentially.
Yes. So, I mean, just off the top of my head, that probably the major company that everyone's talking about at the moment, Thames Water, has a massive debt. You would possibly see that as a target if the price was right.
I would highlight simpler opportunities. That one's very complex for numerous reasons, but I mean,
Yeah.
traditionally, like a Ford company, which has gone into high yield in space and then gone up to IG many times. Kraft
Yeah.
was another company that was IG, went into high yield. And like you're receiving, let's say, a 6% return on a bond, which would be priced at, say, 4%, but the technical was there to mean that those forced sellers improved the yields, and you got an extra 2% just because of that technical. Thames Water is a different scenario where it's going through a restructuring. So it's not just broken that into high yield space, it's gone right through high yield, or what is typically termed high yield,
Yeah.
and into distressed. There, in that distress process, that will drive the performance as opposed to, let's say, the fundamentals in large part. Whereas, maybe the fundamentals will improve, but at this stage, if it's particularly controlled and going through litigation as it is, it's often those
Mm.
technicals that will drive the performance.
Well, we'll get back into strategy in a minute, but
Mm.
can we just go back a little bit and just talk about what's been motivating you to start your own fund?
Certainly. Ultimately, it's this view of stewardship, I'd say. In other words, I want to best serve investors, and I find that intrinsically rewarding. In other words, I was at some very successful large firms, but often agency problems, let's call it, where you're many steps removed from the investor, means that maybe that agenda wasn't adhered to as much as most people would want. So for instance, what I'm very focused on is best serving investors through risk return performance. And one of the core sort of ethos or values for the firm, and broadly where I got my name, even though it isn't called that, I call it that. I have this word acuity. So there's sort of two things on one side that lead to two things on the other. You have a keenness or enthusiasm, hard work, and a sharpness or precision or element of trying to get exceptional sort of skill. That relates to both thought and insight, as well as vision and understanding of the future. So for me, a core sort of tenet is this acuity, where you're really trying to get very good returns via that keenness and sharpness of thought and vision.
Right. Now, how do you get started? Having decided you're going to do it, how do you get started? What was the process that you had to go through to start?
It is a tremendous, I think we could have a probably multiple programs on just that question. It is large and it's lengthy, but on a top level, what I would suggest is, it's key to meet investor needs. And I actually worked very closely with my old employer, who helped me and supported me as to what the fund should be going forward. But broadly speaking, there will be three strategies meeting what investor needs are. The first one, which is SMA, it's called, a separately managed account, is essentially an investor of one. It's probably, I say it's one of the top five, but probably America's largest and most respected university endowment. As a headline, they're giving me, they claim 50 million. And with that, it is slightly levered, but ultimately I'm investing to a set of parameters that that very professional and experienced investor is happy to give me. Following on to that, there's two broad sort of types of product which are very suited to like a European focused fund. There is what I would call traditionally the Cayman fund, or let's say an offshore fund from Europe and certainly UK, and that will suit institutional investors that are outside of the UK or often outside of Europe per se. And there's often tax advantages, for instance, for endowments investing in the Cayman fund. And then secondly, a UCITS product where that suits a very broad base of investors, and typically, yes, your European investors. So at my last firm, I ran UCITS funds. They are a bit more restrictive in their sort of some of the makeup, but I'm very experienced at running that style of fund.
Right. So you ended up with I'm a bit lost here. You ended up with
just one at the moment, but there's two coming through, for a better word.
Right. So that's sort of your vision is that you're going to sort of possibly do the two latter elements that you talked about, but this at the moment you're at the sort of stage one of the mountain, as it were.
Yes, although, for instance, I would have been working, it's probably 6 months on both the Cayman and the UCITS fund already. So they're well down the track. It's just that they do take a long time.
Got it. And how do you how do you sort of meet these investors with large amounts of money? Do you use intermediaries, or is this just a networking thing that you've already got contacts?
It's a good question. There's no hard and fast rule. For instance, there is a number of funds in the market that, over the years have had different progressions where, sometimes they have a blockbuster launch. Some of them have like a slow and steady style. Sometimes there is, such as with the SMA, some form of partnership where that investor might be supporting you. Some of the well-trodden paths, for instance, are where you work closely with a prime brokerage and they do capital introduction. And also, there is specialty firms, let's say, that do the marketing also. I mean, it's a mix of all of those. For instance, the fund that I have, is benefiting because it's been designed to be suitable on a risk-return basis, for instance, to institutional investors. It's not really a retail product. And in that context, it is attractive to those larger investors and ones that, traditionally I've worked with, for many years.
Yeah. So on launch, I mean, how much money have you got to sort of deploy into the market then?
I will have up to about 100 million risk in the market. And that
Right.
for a credit fund is quite important, to be honest. It's unlike equities where there's slightly less yield, there's slightly less returns, but obviously a lot less volatility. And there is necessity of scale. For instance, the high yield market in Europe doesn't have Trace, which is in the US, which is like a ticker or a public index. So it's all traded over the counter. So as an example, you have to set up lines with all the banks. It's quite difficult to get set up actually. And in that context, you need some sort of scale. It's a lot harder than doing, for instance, a traditional equity fund.
Yeah. Yeah. And then once you've sort of got that initial amount and you're looking at these other styles that we talked about, what is your ambition? If I was talking to you in sort of 5 years time, what do you think this will look like?
I mean, I'm not particularly seeking growth. I think that will come with performance, and it relates to that core ethos of the business, which is the stewardship. In other words, delivering the risk return performance that those investors seek and understand that I will deliver. I mean, that's the overall objective. In other words, it's building a franchise, meeting a need, if that makes sense.
Yeah. Yeah. So you're basically saying you don't have a sort of specific, I'm going to be a 10 billion fund by X, but it's more, well, what is it? You have to have
Yes.
something in mind to sort of play with.
Yeah, I mean, for instance, the UCITS fund, I intend it to grow to over 100 million in size within 3 years from its initial launch. And the break even for this first SMA, it's sort of, for a better word, past that in a sense when you're working with 100 million worth of risk. So as long as you keep costs and staffing under control, it should be like evolving and, for a better word, a snowball. In other words, you make sure that you're self-funding as opposed to, let's say, negative cash flows or overextending. So in other words, it's slow growth, but my core focus is delivering performance for investors.
Yeah.
And
Yeah. And
everything else should sort of settle after that. If you don't get that right, then the rest doesn't work.
yeah, of course. And what now, switching gears a little bit, we've talked about the setup. What about the investment process? How do you go about the decision to invest in one high yield above another high yield? And what is the universe that you look at? Is that hundreds? Is it very specific to Europe? Is it, can you do America? What is your investment process?
Certainly. On those parameters, and then touching a bit more on the process also, the parameters, the focus is Europe, but it isn't restricted to European denominated bonds. So I can do sterling bonds, Swiss franc, and even US dollar denominated bonds. I mentioned about, say, Kraft or Ford. They're US companies. They have European bonds, they have European presence. So in that context, I'm able to invest in those sort of credits also. The essence is to say, you focus on where your strengths are. My strengths, because I've done the European high yield for the last bit over 20 years, is that focus. I'm really trying to leverage the skill set I have there. In terms of, say, riskier space, I am initially avoiding that. When I say that, for instance, some Eastern European countries, I won't take exposure there. For my fund, at least, and this is for the SMA, where they've set quite strict parameters. Good rules of thumb are: I can do a Portugal, I can do an Ireland risk, but I'm not going to take, say, a Turkey or a Greek risk. So it's a fairly conservative fund, that one.
Yeah.
Sorry, I was going to say then a bit more on the investment process per se.
Yeah.
So the market itself for European high yields, roughly about 800 billion in size. There's, again, roughly about 950 companies for that size. I specialize in doing, in terms of my longs, and in other words, what I'm owning and taking risk on, I specialize in doing shorter duration bonds. In other words, I invest in the half of the market that is the shorter duration. And duration is the maturity of the bond. So a typical high yield bond is issued with a 5-year maturity or a 7-year maturity. I mentioned earlier, like the midpoint is 3 or 3.5. So I'll buy anything that's a 3.5 maturity or less. So that's one thing. So that 400 billion halves the, the 800 billion halves to 400 billion. And then I might buy, say, 1 in 10 names, hypothetically. So that comes back to 40 billion. And then, for instance, I would never really own more than, say, 10% of an issue. Like for my first fund, this The SMA, I think, own more than 2%. So 2% of
Yeah.
40 billion is still sizable, but that sort of starts cutting it back. Previously, doing a similar strategy, we had 4 billion worth of short duration European high yield, and that was probably a good amount and probably enough of an exposure to the market. After that 4 billion, you'd probably start having, you start compromising the quality of your investments.
Got it.
So no, that's some of the parameters. Oh, sorry.
Yeah.
I was just trying to keep.
I'll jump in and we can go back to the process, but it does occur to me. Obviously, one of the things about any market can go up, can go down. How liquid do you have to be in your position? Are you somebody that has to give up liquidity and sell your bonds if your investors suddenly get nervous, or have you got a period of time to return funds?
The fund is designed to address most of the market shortcomings, and liquidity is one. It's not as deep a market, say, as the US equity market, but it's not small either, as I said. So, for instance, the liquidity question actually is an advantage for my fund relative to peers, and there's a couple of reasons why. One is the short duration nature means it naturally matures. So, broadly speaking, the average hold period is less than a year for my positions. And another way, if you flip that, is then you're selling your full portfolio over a year. So it's roughly 8 to 10% of the portfolio will just naturally mature each month. So in other words, it's continually the bonds maturing, continually generating cash. And like in 2016, with Brexit, a good example, I just didn't buy bonds for about 4 weeks and we accumulated about 12% cash level. Interestingly enough, 8% of the fund was withdrawn because it's an open fund, and we had that cash there. Surprisingly, nothing really bad happened, and they returned all that cash a week later. But we certainly had to be ready for that. But we weren't forced sellers at all, and that's one element. A second element is to say, given its illiquid nature, if you work closely with the banks, often you'll be giving them ideas as to what to take positions and where to take risks. Often, you can be an advantage in that you're working with a lot of the key drivers of the market, such as the banks and their traders, to get liquidity. So you always become a liquidity provider in itself, and that way you actually can be on the other side of that bid-offer spread. You can actually start making money from the illiquidity.
Yeah, I suppose I asked this question because during the beginning of the financial crisis, I acted for a hedge fund called Basis. Basis had bought a great deal of high yield, but also other sort of more funky things. And one of its problems was the fact that as market conditions began to deteriorate and people began to get frightened, they tried to take the money out. So it's always one of those things that's sort of curious to me that in this kind of space that you're at, where people can get a bit more frightened than perhaps other investment grade, whether you're going to suddenly have that dynamic forced upon you. I was just wondering how you address that. Whether you think that's a risk or how do you address that risk?
Yeah. And also, yes, it's a good question, even compare it to investment grade. I would suggest that the bid-offer spreads often are wider investment grade. Certainly, it's been my experience. So in that sense, it's actually more costly if you're doing, say, a 10 or 15-year maturity bond in investment grade versus, say, a 6-month, 1-year bond maturity in high yield. And additionally to that sort of comment, I was going to say, once again, if you know that market very well, you can actually be on the other side and actually supporting it and helping it. And so, in other words, I don't mind that illiquidity because it actually is to my advantage.
Got it. And can you explain, I think we started out in the intro saying it's a long-short fund. So
yes,
I think we understand the long bit, which is just you buy some bonds and hope that the returns are good. Explain, if you could, what do you do in shorting a bond?
Yes. I mean, there's a couple of things here. What would lead a bond to drop in price is a nice question. And I mean, there are no surprises there. A lot of them are fundamental reasons, some are technical, but most of them are things such as the deterioration of the business. Now, usually most businesses won't for a better word, drop off a cliff immediately. Rather, it's death by 1,000 paper cuts or something. And, I think you mentioned Thames Water, that, it's a long time coming and that's still going through its processes. There's a number of other, like Altice, that I think's been mentioned recently. Interim's another one. And all of these, they're a slow progress. So in other words, there are no surprises, but you certainly do need to be ahead of the market. I mean, if there's differentiations from what I do, for instance, it's not just looking at, let's say, the fundamentals and just understanding at a basic level. I mean, most of the companies I've met management 3-4 times, and it's often that third interview or that new management team that comes on that really drives a slightly different agenda. I mean, on a positive, maybe Coty was a good example. It's a US cosmetic business where they brought in a lady that's done excellent work there. Let's say their rating, I can't remember for sure, but let's say it's a weak single B minus. And we took a lot of exposure, not just because of the fundamentals, and the opportunity, but the quality of management there. And it's rare that I back a management because often you want the business to succeed despite the management, and then you have confidence if the management add. But this one did put a bit of value to that quality of management, and then it had 5 notches of upgrade. And in that sense, that was a good example. Whereas Interim's a good example where it's a debt collector, overextended somewhat, was very conservative, led by a CEO that was the CFO, so very tight controls on finances. And then they changed management, and the new management, through 2 meetings I had with them, I didn't think, let's say, had as good a grasp of the business as they should. And certainly, we out all our exposure at that point. And yes, that one deteriorated worse. So sometimes it's the ability and intent of management. Sometimes it's the economics of the situation. I mean, at Birkenstock was a great example where we took a lot of risk. On the long, we expected that business would succeed via an IPO or some sort of exit relative to about 3 of its peers that were similarly positioned and priced. But we just took that exposure. And that was based on the quality of the product and the opportunity we saw there.
Right. And in terms of, I
so
guess,
it's often the evolution of a business.
Yes, and I guess my show's called the Turnaround Podcast, so it's a little bit more focused on distress.
Yes, certainly.
Are you going to go looking for distress, or is it really? Oh, well, I might short some bonds, but actually that is just not an area I'm going to spend too much time on.
It's a good question. So for this first fund with the endowment, it will be in the liquid space. They're all rated. They're all mark to market, daily, hourly, etc. So it won't go into the distress space. There is investor interest potentially for some less liquid strategies, but certainly early days is we're going to stay liquid, and partly because then you're better tracked. I really dislike the idea of this incentive misalignment where something's very illiquid and not marked to market. It's almost like a black box, and often an investor won't know the performance of that particular fund, maybe for 6 months, maybe for a year until it's reported, and even then it's questionable as to the valuations. So I've erred on staying very public, very liquid, and in that context, I haven't gone into the fully distressed. Historically, I have done a fair bit of this, but for this fund, I won't. Historically, those big restructurings like an Agricor or a Waste Italia, where I was leading restructuring. So it's important to have that experience, but I'd not do that now because there's a 5-year turnarounds in some of those restructuring cases.
Yeah, but I think what I'm getting from this is that if you do see a deterioration, you're probably not going to sort of buy the bond and sort of look to get involved in a long, convoluted workout, but you'll probably end up shorting it if you see that opportunity.
Certainly. I mean, and often if it's an obvious restructuring, it's very difficult to short those names. It's often a bit more subtle what you can short. It's very difficult, for instance, both pricing wise on a CDS or borrow when you do it actually as a bond lending. In both those scenarios, sometimes it's very difficult to get short on a particular weak credit simply because everyone's trying to do it.
Yeah, there's nobody on the other side. Now, actually, you used the word CDS, credit default swap. Not everyone in the audience perhaps is going to understand what that is. I'd love to get an experienced market practitioner talking about what is the credit default swaps and how are they traded. And I think you have talked in the past about shorting credit default swaps. How does that work? So I've asked you a lot of questions. It's basically about CDS.
Yes, and I actually think in your third podcast with Wolfgang, I think from Saria, you might have touched on this too.
We
Um,
tried.
yes, yes. For me, I'll keep it even more simple. A credit default swap, it is an agreement for an exchange in the future.
Mm-hmm.
So the exchange is related to the bond. Typically, you're assuming it's at par, and typically you're assuming a certain coupon. But putting all those aside, you're basically agreeing that you're going to exchange something in the future. And typically it's 5 years in the future. Now, that's the structure of what the CDS is. So you're agreeing that you're going to exchange this particular bond, let's call it, but it's basically representative of the bond in 5 years. You're going to exchange it in 5 years. And so if the company performs, obviously, bonds go up and you're buying it cheaply because you've agreed at that price. If it underperforms, and again, set at that price, then you can buy it, but you're forced to buy it at an expensive price. Now, the idea of being long and short of this is kind of a bit immaterial. It's just agreeing to a set price in 5 years. And what happens is over that 5 years, people might trade in and out of it, and the company might improve or deteriorate, a bit similar to what a bond price is. But in this case, because it's agreeing in the future, what they call a long, where you own it, is actually you're owning something that if it goes worse, you go better. And if you short it and it goes worse, you lose. So in other words, the language is just flipped, unfortunately. So if you're short a bond, you're long risk. In other words, if the bond goes better, you get money. And if you own the CDS, you're long the CDS, you're actually short the risk. In other words, if the bond deteriorates, you make money.
Yeah.
So
I
the
think
language is just in reverse.
it's worth sort of saying again to the audience, there are certain things called credit events that if those transpire, like a liquidation or something like that, then that is a sort of galvanizing event that means that the insurance, put it that way, pays out. Is that how you see it?
Exactly. And I mean, it's based on the core concept of if you own that bond and the company defaulted, the bond will be worth zero. So if you own the CDS and it defaults, the CDS is worth zero. Now, the thing is, as I mentioned before, if you're short the CDS, that means you're long the risk. In other words, if it goes better, you make money. So the person who's short the CDS, when it goes through a default and goes back to zero, you've lost all your money. Whereas the guy that is, bought the risk, i.e. they're short, which is a funny language again. Yes, they make a lot of money when it defaults. Yes, so it is a form of insurance.
Yeah. Okay. Well, I hopefully people are slightly better off for understanding that. Okay. Well, let's move on. I just want to talk about the sort of current market outlook at the moment. I mean, I think we're talking at such sort of historic times with a new presidency. The Western Alliance under some pressure, tariffs. I mean, it's there's a lot to talk about, but how do you see the outlook for junk bonds, as it were, the formerly called junk bonds, high yield bonds now? What is your outlook on this as an investor?
Okay. There's probably two layers or two references. One is, let's call it where the market is itself on its pricing. And then secondly is the influences on that market going forward. It's important to note that with bonds, they do, as I mentioned before, get a coupon and they do get repaid at par at maturity. So bonds might trade up and down, but ultimately they sort of reconcile to par if they perform. If they can default, is the alternative, but if they do that. So in other words, you can actually mechanically work out, in a sense, what the returns are going to be if, you assume a, minor default rate. And at the moment, there's a couple of things to say. In 2022, there was a very weak market. Interest rates increased, like the bond or the Euribor went from about negative 50 basis points to about 3.5. So it was a big move. So the markets went wider. Since then, there's been a very strong rally. And last year was a good example of that. For instance, each month last year for European high yield, the bonds improved in price on average. There was not one down month. There was about 8%, 8.5% returns last year in 2024. And it was much better in 2023. So we're coming off a very strong market. And in that context, there's not much more yield to be gained from the bonds in terms of they're not priced below par anymore. So in other words, you're going to get the coupon, but not much else. That's one element to think of. So that sort of yield, I think most people are probably thinking of a 5%, maybe, on a good year, like where the market even goes tighter from where it is now, it goes to 7%, 6%. And if it's a bad market, it might be a 3% yield. That's sort of the range. Now, maybe one reference is to say is if you look historically as to how tight the market is, it's on about one standard deviation, about 33% of the time the market has been tighter for Europe, but 66% of the time it hasn't been. Interestingly enough,
And
in the
so,
US,
I'm cutting you there simply because I know that a whole bunch of people may not know what tightness means in a market context. Can you say what that means?
Yes. I mean, we talk about a bond having a yield, which is the coupon, and also like the movement of the principal price back to par. So that's yield. And then that's your all-in yield. But often people will separate that yield to two components. One is the risk-free rate, which is about, say, 3 to 4%, depending on if you're in Europe or the US, etc. Typically, that sort of aligns with your mortgage rate. And the second thing is, let's call it the risk premium, which is related to that single name company risk. So that's, when I say the spread, it's the actual premium above the risk-free rate. And usually, like for instance, there's one index which has all the derivatives, let's call it, for the market, and that's called the crossover, that has the most liquid derivatives. And the crossover is about 300 basis points at the moment. In other words, it's 3% above the risk-free rate. That's the average yield.
And I think I interrupted you rudely when you were just about to launch about the US and your views on the US.
I was just going to mention relative to Europe, which is one standard deviation tight. In other words, 66% of the time it's been cheaper. In the US, it's 2 standard deviations tight. So 95% of the time, the market has been cheaper in the US. So the US has actually gone a lot tighter. It's in the top 5% of the most sort of tight or low, most expensive, another way of calling it, markets, whereas Europe's only in that 33% range.
Yeah. So I think in that context, people might sort of call that almost price to perfection. As in you're basically buying a bond that is expected to repay very little sort of risk, and obviously if that doesn't transpire, then the market's going to suffer a bit. So I was wondering what you thought of the default rate or the likelihood of defaults in the next few years.
It's a good question again. There's higher interest rates generally, as I mentioned, and that is a greater hurdle for many companies that were used to quite low coupons or low interest rates. So we could assume broadly the European high yield market is probably paying close to double the coupon that they did pay up until about 2021. So the average company that was a single B might have paid a 4%, 5% coupon. Now they're paying, let's say, between 7 and 10% coupon. So it is far more expensive, and that is certainly a challenge. That's one element. I wasn't sure if I should add to that.
Yeah, carry on. Yeah, well, I think, well, one thing I wanted to just talk about is the difference between credit markets and equity markets. I think we've spoken about this in the past. You seem to have the view that credit markets are less efficient than equity markets. Is that have I got you right on that?
I was certainly highlighting that just earlier in our chat related to European high yield, because there's no, for instance, index or ticker that sort of marks all the prices, that registers all the trades. So it's an over-the-counter market, meaning that I have to phone up typically a bank. And there is a few, for a better word, independent exchanges that operate. But I have to phone up a bank, agree to a price, and there's no way that that's getting marked to market, or no one's seeing that price. It's not on a public ticker, even though there is quite good technologies that bring those views together at end of day, let's say. So that's one element. That means that it's less efficient. Another is that, say, in an equity market, you issue a company. It's a equity investment, let's say. It stays there. It's outstanding. It's a very simple product. In European high yield, you've got that 150 pages of legalese for each security that dictates how it might be exchanged, how it might be restructured, how it might affect things like, for instance, if you have protections as to the bond actually has claim on the assets of the company, or you can strip those out. There's a number of elements. So ultimately, those covenants are quite challenging to understand, and often it's not just what's written in the law, but in practice, what happens through legal cases, like through restructurings. Unless you've gone to a court a couple of times, you don't really know what's going to happen. And now you need to know those sort of things to make sure that your investments work for you. So those are elements where it's less, let's say, efficient, but it does have a core role. I mean, as an example, I did highlight it's less volatile because of all these covenants and protections, and that you get paid at par. A good example of that, when I said that, the average maturity is 3 years. So that means if a company goes well over 3 years, it's going to go up. You have a fairly good visibility of how that company is going to go. If you compare that to equities, where they might give, say, a 3%, dividend each year. So over 33 years, roughly, you're going to get your money back that you put in. A nice way to think of that is, that midpoint of those cash flows is about 15 years. And why I say that is because if you're an equity investor, what you're really focusing on is how's that company going to perform in 15 years' time. You're trying to assess things like addressable market, moats, as an example. Those elements mean that, over the long term, the company will perform or not. But there's a lot of noise in between. It's very inaccurate. So there's a lot of visibility when you go into bonds, which mean that you can do the technicals, you can do the work. If you understand it, you might have a genuine advantage.
Yeah. I mean, the way I see this, I remember in the lead up to the Lehman crisis, the credit markets were tanking and the equity markets were, pretty exuberant, still going up. And I came to the conclusion at that point is that the equity markets, yes, they may be more efficient and more technology and maybe a bit more liquid, but ultimately they seem less rational to me in some ways. There was a sort of, in the debt markets, you've got, seasoned, gnarled professionals like yourself who are doing the trading, the assessment, and the equity markets, you've got, lots of people who aren't particularly, knowledgeable, experienced. Do you think that's a fair assessment, or actually, do you think debt markets can be just as irrational as equity markets?
I think there might be a lot more technical factors to the high yield market, but this is just a parallel that comes to mind. Is I always remember, and it's a famous sort of example, but Picasso is an example. He did a sketch, in his later years on a napkin, just 3 or 4 lines, and it looked like a beautiful picture. And the lady wanted to say, "Can I have that?" And he goes, "No, because even though it took me a second to do, it's a lifetime of development." So I do think even if the equity markets are, let's say, more clear and simple in some technical aspects, there's still an art, and those that are the best at it can make a difference. But certainly from my area, yes, I think there is ample opportunity to make significant performance. And as a good example, hedge funds generally, usually or traditionally, is about 60% were equity long short, and actually fixed income, like such as high yield, didn't exist as a long short product.
Yeah.
And now it's about 5% of the market. I expect it will grow to about 15% of the market. I would suggest that many multi-managers that are in the market, the famous, the Citadels of the world, etc., they do a lot of this. And certainly, they do the long shorts on credit, let's say. But it's a very new market. And in that context, again, it's very inefficient. I do think in time it will become more efficient. And certainly I try and lead that change. I'm trying to look after the health of the market. I'm very motivated, actually, for a smooth transition from the pension holder that's investing money to the company that actually is issuing, or seeking debt financing, that value chain. I'm very keen for that to be efficient. And I certainly think, long short funds, a key component of that to sort of iron out inefficiencies in the market.
Yes. Now, pretty much the final question. How do you see technology shaping credit markets and investment strategies in the future?
I guess some immediate applications that have happened in recent years is the data itself. Again, it's an inefficient market. And I highlight that from the perspective that there's, say, 900 companies that are all reporting quarterly. And with that quarterly reporting, it's a case of, there's no public exchange like Edgar's in the US that record all this information. So now there's scanning technologies that will look at all that information and I run like 450 models, quarterly results, 350 lines per company. And I can do that through that technology. Whereas I used to do that with, I used to run as a full-time job when I first started in investment banking, like 60 companies. And that was, well ahead of my peers who were running 5 to 10 names. That's one element. Another example is scanning all the covenants, which is that 150 pages per company. Again, there's a lot of technologies now that look at the thematics of those scannings and can distill that information very quickly and have it on a comparative and clear basis. And also even on the AI, I mean, for high yield and for my investing style, it's quite quantitative in itself. I mean, I think there's great applications there. I mean, as an example, I used to, on a weekly basis, look at, say, 10 factors that drove the performance of all the companies I had exposure to. And I do regression analysis, reweighting them, looking at their influence. And those 10 factors were quite accurate, and they'll give me often sort of trading rankings, let's say. So not always the fundamental views, but execution was quite good. But now I can look at about 350 factors and iterate correlations to reduce, say, noise, and actually get some very clean insights that I couldn't have done before because I just didn't have that capability. But it gives you that expanse of skills that you didn't have before.
Yeah. Well, it's interesting. As a lawyer, people are trying to sell me products where, particularly with documentation, you might have a huge number of high yield bonds, and you might want to start sort of comparing or just asking a question, what are the debt baskets, and then making comparisons between all the different ones. And obviously, in the old days, you've got the documents, you have to sort of laboriously look it up, etc. These kind of products that are coming out using AI are obviously just going to be able to give you that answer quite quickly, I presume.
Yes.
So it's going to be interesting, and I feel like I've taken a lot of your time. Is there anything I didn't ask you, Clark, that I should have asked you?
I mean, in terms of the market outlook, I would highlight there is still quite a number of opportunities. That was one thing, not so much the actual pricing ranges, et cetera, and the geopolitical risks, but as an example, what's happening now, and there's always different things, but as a good example, the market is quite tight for single B and double B credits, which are the sort of the core area for high yield. But the triple Cs are actually trading at wides that are still at the levels of what was in 2009. And a simple way of analyzing that is to say there's roughly, say, 50 names at the triple C sort of credit rating. And maybe 5 of those will default, but that leaves you 45 with ample opportunities. So there's unprecedented opportunities there if you do the credit work. And another one is the maturity wall. Because of the difficulties in the last couple of years, still there's a very large maturity wall that is being addressed. And those refinancings give you a lot of pull to par, it's called, where if there's a low coupon product, which you say a 5% coupon, the company's yielding 10%. If it's a 2-year maturity, you're getting 5% in principal each year. So in other words, the bond is trading at 90 because everyone expects you get 5% appreciation in bond price. But usually that bond will get refinanced a year and a half early. If it gets refinanced a year and a half early, that's only 6 months away. So that 90 price moves to par in 6 months. So you're getting 10% annualized return, or 20% annualized return plus the coupon. So you're getting a 25% return for something that is yielding 10% in 6 months. So that's very good yields, and that's a real opportunity I still see there in the market.
Okay, well, I'm going to finish there on that happy note of 25% returns. I think it's been really interesting. Thank you for sort of opening the veil a little bit on a sort of very, a few technical wizardry that you're obviously going to be doing in the next few years. And thank you for being on the show, and very best of luck in your new venture. And hopefully we can have you on in a few years' time and you'll be telling us how many billions have been invested.
Yes, or how well the performance has been. That's what I'm focusing on. Thanks so much.
Thank you very much.
You've been tuning in to the Turnaround podcast with your host, Stephen Phillips. You can find this show on all the major platforms, including YouTube, LinkedIn, Facebook, Apple Podcasts, Spotify, and on our website, freilibertas.com. thank you for your positive reviews, comments, questions, and for sharing this show with others.